There is a siren wailing in the deep plumbing of the global financial system. But because the frequency is so low, most people can't hear it yet. While the country was distracted by New Year's toasts and holiday distractions, the structural integrity of the American economy quietly buckled. We witnessed a financial anomaly that shouldn't exist in a functional market. In early January 2025, the 10-year Treasury yield, the most important number in global finance, didn't just tick up, it violently lurched past 4.80%. This brings us to the terrifying reality we analyze here at the Economic of Fallen Empires. This spike happened after the Federal Reserve slashed interest rates. Picture a driver slamming on the brakes, only to have the car accelerate. That is mechanical failure. The Fed is desperately trying to make money cheaper, but the market is revolting, driving costs higher regardless of the central bank's wishes. The engine block of the U.S. economy is cracked, and the reason is stark. The whales are leaving the casino. For decades, foreign central banks were the guaranteed buyers of American debt, the backstop that kept the game running. That era is over. China, once the voracious consumer of U.S. treasuries, has essentially folded its hand. Their holdings have plummeted to a mere $680 billion, a ghost of the $1.3 trillion they held a decade ago, and the lowest point since the 2008 crisis. They haven't just trimmed their position. They have dumped nearly half of it. India is doing the same, slashing their exposure to under $200 billion, while frantically vaulting physical gold. Europe, holding an $8 trillion mountain of dollar-denominated assets, is no longer a passive ally. Behind closed doors, they are drafting the financial equivalent of war plans, capital controls, and forced divestment strategies should American foreign policy become too volatile. These aren't conspiracy theories. These are the cold, hard numbers from the Treasury Department itself. The greatest debt supercycle in history is beginning to unwind. Over the next few minutes, we are going to tear down the curtain. We will expose why the financial media is ignoring this tectonic shift, and most importantly, how you can construct a fortress around your wealth before the repricing event destroys it. Because whether you hold deeds, stocks, or just a savings account, the value of everything you own is about to be violently recalculated. The bond market acts as the truth serum for the economy. Politicians can spin narratives, and the Fed can issue calming press releases, but bonds only speak in price. And right now, the bond market is screaming that the system is broken. When the 10-year yield breached 4.80%, despite the Fed's rate cuts in late 2024, it was a declaration of no confidence. The market effectively looked at the Federal Reserve and said, "We don't believe you. This inverse relationship is brutal. As yields rocket upward, the value of the bonds sitting in portfolios crashes. If you own treasuries, you are losing money every second the yield climbs. But the contagion doesn't stop at bondholders. This yield is the gravity of the financial world. When it increases, it drags everything down with it. Consider the federal government's own checkbook. Washington now burns through over $1 trillion annually just to pay the interest on the national debt. That is a bill larger than the entire defense apparatus, larger than Medicare. We are spending $1 trillion not to fix bridges or fund schools, but simply to service the past. And that calculation was made when rates were polite. At these new, hostile levels of 4.5% to 5%. That interest bill is mathematically destined to explode toward $1.5 trillion in the next 12 to 18 months, as cheap old debt matures and rolls over into this expensive new reality. The pain radiates to your kitchen table. Mortgage rates are tethered to that 10-year Treasury yield. When the benchmark hits 4.8%, mortgages leap to 7.5% or 8%. The math of homeownership breaks instantly. A $500,000 home that was manageable at 3% becomes a financial death sentence at 8%, with monthly payments soaring from $2,100 to nearly $3,800. That is a 75% overnight inflation of shelter costs. The housing market faces a binary outcome. Either prices capitulate and crash, or the entire sector freezes into ice. Corporate America faces the same wall. Businesses addicted to cheap 4% money are staring down the barrel of 10% refinancing rates. Companies laden with debt will find they can no longer afford to exist. This is the mechanics of a recession. Bankruptcies cascade and pink slips follow. Why is this happening? It is a crisis of supply and demand. The U.S. government is printing debt like confetti, but the foreign demand that used to soak it up has evaporated. Let's look at the strategic chessboard. China's exit is calculated and aggressive. They have offloaded over $600 billion in U.S. paper, accelerating the dump by $200 billion in just the last 24 months. But they aren't sitting on cash. They are transmuting paper promises into hard geology. While their official reports claim modest gold purchases, independent forensics suggest China is actually importing closer to 1,000 tons of gold annually. They are building a financial bunker, accumulating the one asset that cannot be frozen, sanctioned, or deleted by a SWIFT code from New York. They are preparing for a post-dollar world. This is a global coordinated maneuver. India, Russia, Turkey, Singapore, the central banks of the world are selling the dollar and buying gold at a pace we have unseen since the frantic days of the Cold War. In fact, we have crossed a historic Rubicon. For the first time since the 1990s, global central banks hold more value in gold than they do in U.S. treasuries. They have voted with trillions of dollars, and the verdict is against the American debt system. But the true black swan is Europe. This is the angle we frequently discuss on the economic of fallen empires. Europe is the heavy artillery of foreign capital, holding $3.6 trillion in treasuries and trillions more in equities. Currently, Brussels is wargaming the nuclear option. If geopolitical tensions with a volatile U.S. administration escalate threats to Greenland, friction over NATO Europe is preparing to weaponize its balance sheet. Imagine a directive from the European Commission forcing a 20% reduction in U.S. assets. That would unleash a $720 billion sell order that would snap the spine of the Treasury market. Yields would scream to double digits. The U.S. deficit would become unfinanceable without direct money printing on a scale that would make the 2020 stimulus look like a rounding error. This is the trap. If the Fed prints the money to buy the bonds that foreigners won't touch, that cash has nowhere to go but into the domestic economy. In 2020, we exported our inflation because the world wanted dollars. Now, the world is rejecting dollars. The inflation would be trapped inside American borders. We are looking at a scenario where the cost of living doubles in under 2 years. Weimar economics arriving in the suburbs. The data confirms the exodus is already underway. The Cayman Islands, a proxy for hedge funds and Chinese capital, is selling. Saudi Arabia is selling. Even reliable friends are quietly backing away. The U.S. government needs to borrow $2 trillion this year, but the lender's window is closed. This leaves the Federal Reserve as the buyer of last resort. They are trapped in a doom loop. They cut rates to save the economy, but the market spikes yields because it fears the inflation that comes next. If the Fed intervenes to crush yields, they must print trillions, which destroys the dollar, which causes more foreign selling, which spikes yields again. It is a death spiral. So, where does this leave you? If your wealth is parked in standard U.S. stocks, you are unknowingly leveraged on foreign confidence. That confidence is gone. If international capital pulls just 10% of its equity stakes, we will see a 40% air pocket in the S&P 500. The AI bubble, built on the assumption of infinite cheap capital, will burst. If you own long-term bonds, you are holding a melting ice cube. You bought safety, but you bought it in a currency that is being debased. A 10-year bond bought 2 years ago is already underwater, and if yields climb to 7%, Your safe asset loses a third of its value. Cash is no longer king. It is a victim. When the government's only solution is to devalue the currency to pay its debts, holding dollars is a guaranteed loss of purchasing power. The only way to survive the transition of a reserve currency is to own things that cannot be printed. Gold is currently tearing through all-time highs, signaling that the smart money has already moved. It is the ultimate insurance policy against a government that has lost its fiscal mind. Silver and productive land follow the same logic. We are watching the end of a 50-year arrangement where the world accepted the dollar as good as gold. That trust is broken. We are entering the chaotic transition period that the economic of fallen empires was created to document. The indicators are flashing red. Gold is breaking $2,550 in early 2026, targeting $4,700. Yields are rising against the Fed's will. The foreign bid is dead. You need to pivot. Diversify out of pure paper assets. Reduce your debt load before the variable rates crush you. Look at international markets that aren't tied to the sinking anchor of the U.S. deficit. Watch the central banks. They are building lifeboats of gold while telling the public to stay on the ship. This is a slow-motion collapse, a grinding destruction of wealth that will play out over this decade. But for the unprepared, the damage will be permanent. The exodus has begun. Do not be the last one holding the bag. If you want to survive the fallout, make sure you are subscribed to the economic of fallen empires. In our next briefing, we will break down the specific portfolio adjustments you need to make to weather the storm. The dollar's reign is ending. Make sure your prosperity doesn't end with it. Stay vigilant.